Advanced Financial Management, AFM. That's how we call it. All right. So then I would start right away, and I would want to connect this with a very important topic that you guys are so much aware of, known as investment. And I would want us to look at how to invest using portfolios. Portfolio. So in this case here, we are looking at what we call portfolio management, a topic that rarely misses in your exams. Now, ladies and gentlemen, it will be very important, of course, you're making your own notes there pretty fast. Don't write this in your normal, if you're my student in my class here, don't write this in your normal notes. This is just an extra session, free of charge session that I'm using to basically bring so many students to RCM College. This is our number. For those of you who may be interested in our programs, 0793 555 000 is our number. I would want to really welcome you guys to study with us. Now, when we talk of a portfolio, I would want you first of all to remember this old adage, which our moms in those very, very old days, from the 60s, I mean, very early, they knew about portfolio management, an aspect that most of us are not utilizing, and yet it is really, really old. Now, our old great grandmothers, ladies and gentlemen, used to tell us that you should never go to a market with all your eggs, in this case here, being put in one basket. All right? That you need, in this case here, to spread your risk and have your eggs, for example, split into two groups, have, like in this case here, them kept in two different baskets here. So that should you stumble on a rock along the way as you're going to some marketplace, should you fall down, then automatically, of course, there is no way you'll be able to fall. No, perhaps you'll fall trying to protect one basket like this, so that you may lose some eggs, in this case, in this basket that has been able to hit the ground. But of course, you'll be able to salvage something on this other basket. So we should never put all our eggs in one basket. So basically, they were telling us, even in our investments, we have to endeavor to invest in different vehicles if we don't want a situation where one vehicle, if you invest in one vehicle and it crashes, then you end up losing everything. Ladies and gentlemen, here it will be very important for us to know from the word go that a portfolio is a combination of what here? This is a combination of many assets here. A combination of many assets. So when you get your cash, for example, this could be pension cash, never ever invest in just one asset. And ensure that some of this money goes to asset one, other money goes to asset two, other money goes to asset three, other money goes to what we call ETC like that. In short, spread your risk. I've this story that I normally give you guys all the time about a friend of mine who retired from KQ, and KQ was really the pride of Africa. When KQ was up there, Now, ladies and gentlemen, this guy got about Kenya shillings 15 million. In form of a retirement, in form of a pension. Those days, 15 million was huge money. So this gentleman came to some place here along Thika Road, Clay City, and invested in a good building. Very good building. In those days, 15 million could do 4 floors comfortably up to finishing. It was huge money. All right. So this guy finished very well. He got a high level kind of client because of the proximity of the building to the superhighway. So he got good clients really. A few months down the line, he got visitors coming from government, to be specific, NEMA, telling him that this house has been built on a riparian land. So it just began like a joke like that. And he thought that it was really a joke. So those guys disappeared again for a number of months. Later on, another team came and it was able to put that star in red, big star like this. That this house is being marked now for what? For demolition. And that day of demolition came, they brought that tractor, which does like this, and the entire house, having in this case 15 million pension money, went down, and he never salvaged Nothing. Since that time, up to date, that mzee's life has never been the same. We may make a mistake also ourselves as gentlemen. We really keep on making mistakes all the time, but making a mistake with pension money is not really the very, very best. If this gentleman knew that this 15 million, it would have been good for him to spread this cash into various assets, I'm 100% sure that they're fine. Perhaps one of those assets would have been that building, but of course now at a smaller scale, maybe a house worth 5 million, right? That house would have gone down. But today, you will be having some other assets, in this case, you're standing worth over 10 million. So then what we normally tell our students of finance, for yourselves, and of course, the people that shall be advising after, later when you qualify, you become, in this case, here, consultant. If you have this 15 million, the first asset that you will have, for example, if you have land or property, then you can have property, for example, worth 5 million. Have in this case here, for example, another 5 million going into corporate shares. Have another 5 million, for example, going into government bonds. You know, government bonds are very good because here the return is really secure. The return is secure. So if you spread your risk this way, should we have a problem with one of the asset classes, then automatically you will have the other assets here to fall back to. You will have other assets, in this case here, to fall back to. So it is very important whenever you are talking of portfolio to always think about spreading your risk. You spread your risk like this. If you are able to spread your risk like this, then you shall never have a problem. Now, whenever I teach this topic, especially at this level, I always get some young, cheeky students telling me, Mwalimu, how about marriage then? Can I marry two wives in this case and say that I'm spreading the risk? That does not apply to us in finance. Here we are talking about what here? Money. We're talking about what here? We're talking about money, resources, not human beings. The other one now, we don't even comment at all. We don't comment at all. Now, ladies and gentlemen, what are we required to understand in this topic here? We are required to understand in this topic that investors go for formation of portfolios. Investors go for portfolios ostensibly because they want to minimize business risk. They want to minimize business risk. And as we shall be seeing later on, business risk has got two components. Business risk has got two components. We have what we call systematic risk. We have what we call systematic risk. And then we have what we call unsystematic risk. So in this case, they want to reduce business risk. And we are saying that this business risk has got two components. We have two components of business risk. We have two components of business risk. Number one, we have what we call the systematic risk. Number one, we have what we call the systematic risk. And then number two, we have what we call the unsystematic risk. Unsystematic risk. So we have systematic risk and unsystematic risk. If I am to draw this on a graph, this is how this graph will look like, my friends. This is how this graph will look like, my friends. We shall have here what we call the business risk, and then of course we shall have here the number of securities forming a portfolio. Securities will be shares like that. So you can see here, as we increase the number of securities in a portfolio, the risk is reducing. Yes, the risk is reducing, but this risk can never reduce like it goes down to zero. It's not possible for this risk to go down to zero. Not possible. Because there will be that risk that can never be reduced. There will be that risk that is inherent in our businesses, in our investments, even in our lives permanently. That risk can never, ever go down. So please listen. This risk, I should be able to come and divide it into two. So we have this risk being divided into two like this. We have this risk being divided into two. So we have this component of risk here that now has stabilized, that will never, ever do what here? That will never, ever go down. That will never, ever go down. That will never, ever go down. This risk that will never, ever reduce here is what we are calling the systemized, is what we are calling the systematic risk. This is the risk that we are calling systematic risk. And then now these are the risk here is what we are calling unsystematic. So from this diagram, if you're able to see this diagram very well, you can easily get to differentiate between the two types of risks. That unsystematic risk is the risk that reduces. It reduces as the number of securities increase. And systematic reduces, but systematic from the word systemized, from the word uniform. Systematic risk is that risk that will always remain constant, regardless of the securities you have. Even if you are to have 1 million securities, systematic risk can never be reduced. 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 Ladies and gentlemen, I would want you to confirm whether we are together. Are we really together? Please confirm. Let me know whether we are together. Please confirm. Let me know whether we are together. Confirm there. All right. So I hope we are together. Let me see the comments here, including the students who are following me on LinkedIn, the ones in this case here who are following me on YouTube, Facebook. I would want you to confirm whether we are together. Put down a comment there. It's very important for me to know whether we are together. And of course, as we preach this gospel of portfolio management, I would want to invite all of you to come and do what here, to come and be my students at RCM College. So at RCM College, we charge Kenya shillings 4,800 per paper for the online virtual classes. It's 4,800. And this is our number. If you really would want to come and be part of this winning team, this is our number, 0793 555 000. Please join us and we shall be able to ensure that your journey towards becoming a CPK will be smoother and shorter, So systematic risk, from the word systemized, uniform risk. It is that risk that will never do what here, that will never reduce, And then we have a systematic risk, the risk in this case here that now reduces as the number of securities do what here, increase. Listen, ladies and gentlemen, systematic risk in this case here is that portion of business risk that you cannot reduce. It is macro. It is not even security related. It is bigger in the economy. You can imagine if, for example, you have lots of money, could be having like billions and billions. And then you say that I'm going to take some money, invest this money in the banking industry, some money in this case in the hotel industry, some money, for example. What if, for example, we have war? If war was to erupt, like it erupted sometime, serious war erupted sometime back in Southern Sudan. So we had banks closing, equity closed during that time. We had hotels closing. So there is that component of business risk that can never be, which is macro, which is bigger than one individual, which basically cuts across all industries. Please listen, systematic risk is that component of business risk that cuts across all industries. That you as an individual or as a group of investors cannot manage to reduce because it's bigger, it's macro. It's bigger, it's macro. It's affecting all the industries. It's affecting all the companies. It's affecting, in this case here, like the floods that we had here the other day. Of course, they don't spare anything. When we have, in this case here, for example, Al-Shabaab knocking our towns here, they don't spare any business. But whenever we talk about unsystematic risk, now these are company-specific or industry-specific risks. These are those risks that you can easily run away from by avoiding to invest money in those industries with that kind of a risk that you hate. A good example of unsystematic risk is the foreign exchange risk. If I'm really, really scared of foreign currency, then I will just avoid all companies engaging in businesses of importation and exportation, and I'll avoid them. And then I'll be able to invest, in this case here, in these other industries. So unsystematic risk is that risk that crystallizes in just one company or one industry. So that an investor can easily run away from that industry in order to minimize my total risk, 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 in order to minimize my total risk. Very good. Ladies and gentlemen, one thing that I would want you to sorry, I got into a technical problem, but it's good that I'm seeing that all of you are still around. So can you kindly confirm that you are able to hear Mwalimu? Kindly confirm that you are able to hear Mwalimu. Kindly confirm that you are able to hear me. Kindly confirm that you're able to hear me clear. Thank you so much. Thank you so much. All right. So then we continue here, and I can see it is still recording, of which you guys will be able to get access to this recording later. So the things that this examiner would want you to know, first of all, is how to get from your syllabus. Your examiner wants you to know how to calculate expected returns, how to calculate expected returns of individual securities. So expected returns of securities and the portfolios. This one, your examiner wants you to know how to do it. Number two, he wants you to know how to calculate covariances. How do you calculate covariances? Your examiner wants you to know how to calculate standard deviations of securities and the portfolios. Standard deviations of securities and portfolios. And then lastly, ladies and gentlemen, your examiner wants you to know how to calculate coefficient of correlation, and of course, coefficient of what year? Variation, as the first step before you look at portfolio performance, arbitrage pricing models, etc. So then I would want us to go straight away to our past papers. So do we have past papers, my friends? Do we have past papers, my friends? Seems like most of you don't have. Seems like most of you do not have these past papers. It seems like most of us don't have these past papers. It's very easy. You simply buy this kind of a revision kit. These are RCM's revision kits, very nice revision kits. So once you have them, then automatically you are sorted out. We charge Kenya shillings 1,000 per subject year. Like this is RCM's AFM revision kit. Very good. Very good. So then, gentlemen, I just want to get like a question that you can begin with. We should be able to get a nice question to begin with right away here. Which question is this? Very nice question. Or before I go to this one, which talks about CAPM, because I can see most of them in the past papers are CAPM, I can just give you a simple question here. Just a simple question here. This simple question here to lay a foundation for us reads like this. So we have here economy. The economy in this case here could be at the boom. It could be depression, at depression. It could be on recession here. And then of course they will give you probabilities for this. So probabilities, here we have 0.3, here we have 0.5, here we have 0.2. Because the total probability must add up to 1. Total probability must add up to 1. Thank you so much. I can see now we are 17. This shows that you guys are really serious and you would want us to really study. So we have here probabilities. So those are probabilities. From there, we have two types of securities. We have returns of X in form of percentage. This could be 12, this could be 15, this could be 16. And then we have returns of Y in form of percentage. This could be 16. We have here 18, and then we have 27 like that. We have 27 like that. Ladies and gentlemen, we are required here, as per what I've given you, to get expected returns. To get expected returns of X and Y. Expected returns of X and Y. Expected returns of X and Y. And then number 2, they want us, ladies and gentlemen, to give them the covariance. Covariance between X and Y. Covariance between X and Y. They want us to give them covariance between X and Y. And then for today, lastly, they want us to give them, in this case here, expected return of a portfolio, expected return of a portfolio, expected return of a portfolio with 20% of X, 20% of X, and 80% of Y. 20% of X and 80% of Y. So there is somebody who has formed a portfolio. This portfolio, he has brought in X and Y in these proportions, 20% X and 80% Y. I would want someone to confirm to me once you're able to finish writing down this question. Once you finish writing this question, whether you're on Facebook or LinkedIn or YouTube or Zoom here, please put your thumbs up or simply tell us yes. Simply tell us yes. Simply tell us yes. You simply tell us yes, Mwalimu, now we are finished. You simply tell us yes, we are through. So I'm waiting for your signal to continue. I'm waiting for your signal to continue. Like I can see from Nancy Kerubo. And don't forget, ladies and gentlemen, I'm giving you this free session today from RCM College. Our number is 0793 555 000. 0793 555 000. That is our number. That's our number. Please get in touch. We have virtual classes. All right. So these virtual classes per subject, we charge Kenya shillings 4,800. And we have in this case here all CPA papers and ATB papers. All of them, including business data analytics, although business data analytics we charge a little bit expensive at 9,000. All right. So now that I've gotten a signal to continue here, I will come here and first of all look for expected returns. I will come here and look for expected returns. So that's number 1, expected returns. So we have here ERX. How do we get expected return of X? It's very easy. To get expected return of X, what we shall do is to take the returns of X provided times the corresponding probabilities, and then you sum. You take the actual returns of X given times their corresponding probabilities, and then you sum like that. Expected means what here? You simply take the actual returns of X times their corresponding probabilities. So in this case here, do we have these actual returns of X? Yes, they are here. They are 3, 12, 15, and 16. So in this case here, I would want to average. You know, I don't know between the 3 which one is going to prevail. So I'm going to average them by incorporating operation of the probabilities. So what I'm going to do here is to come and take here the actual. So we have here 12 times 0.3. That is the first one. Plus, so plus 15 times 0.5. Plus, we have here 16 times 0.2. So is there somebody who is able to give me this figure? Is there somebody who is able to give me this figure? Expected return of X. So whenever they talk of expected, they mean an average. And to get an average, wherever there are probabilities, we simply multiply. So according to Nancy, we are getting 14.3. Thank you so much. 14.3. You can ignore the percentages. All the figures here will be in form of what your percentages. So that is expected return of X. How about expected return of Y? So expected return of Y, we have the returns of Y here. We have the returns of Y here. So we shall take, in this case, remember the probabilities are shared. Probabilities are shared. So thank you very much. At least I've seen some Zoom student who's really giving me these figures. I expect to see the same on all these social media handles that I am projecting this session. All right, all those social media handles. We expect to get answers there. We expect to get comments there. We expect to be followed by you guys. Even the guys who are following me on Zoom here, later on, I would really request that you go to LinkedIn, search for RCM College on LinkedIn and follow us. Search for RCM College on LinkedIn and follow us. So we have the expected return of Y. So expected return of Y, we have is 16. So it will be 16. So this will be 16 times 0.3. Probably share there. Plus 18 times 0.5. Plus, in this case here, 27, plus 27 times 0.2. So is there somebody who is able to give me this answer? Is there somebody who is able to give me this answer as the expected return of Y? Expected return of Y. So according to Aaron Pichumba, it is 19.2. Thank you so much. 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 Now, ladies and gentlemen, having gotten that, actually the next thing will be for me to come and do number 3. The next thing I would want to do number 3 because it is really connected to the first one. So number 3 is about a portfolio. A wise investor does not want to invest in X alone, nor invest in Y alone. So he wants to consolidate and invest in X and Y. So how do we get to invest in X and Y? So to be able to invest in X and Y, ladies and gentlemen, they want us to go ahead and give them expected return of what year? They want us to go ahead and give them expected return of the portfolio. So they want us to give them expected return of the portfolio, which has got 20% X and 80% Y. Remember, this is very easy. A portfolio is a combination. A portfolio has got this X. So in short, we should take here expected return of X plus expected return of Y to be able to get expected return of the portfolio. But if we do that, we shall be very wrong. If you are making an assumption that you invested in X 100%, no. You need to come here, ladies and gentlemen, and attach the weights. So you talk of weight, expected return of X, plus weight Y, expected return of Y, like that. So do we have the weights? Oh, yes, we do. Weight X, we have been given. Weight X, they gave us 20%, which is the same as 0.2. 20% times expected return of X, you guys have already given me this. Expected return of X is 14.3. Plus weight Y is 80%. So we have 80% times expected return of Y. Expected return of Y, ladies and gentlemen, is 19.2. Expected return of Y is 19.2. So remember, when you're punching this will be punched as 0.2. 0.2 times 14.3 plus 0.8 times 19.2. Do we have any great ninja who already has the answer? Do we have any great ninja who already has the answer? Please, I'm getting these answers here from Facebook, from LinkedIn, from all our social media handles. That is how we really want to hear from you, because we want, in this case, here to engage. So according to Bwana Aaron, he's getting 18.22, but I can't work with one student's answer alone. I need faith is also confirming. Faith is also confirming. So there is corroboration happening here. There is corroboration evidence happening here. 18.22. 18.22. The thing that you're supposed to know, you can't ignore the percentages of the weights. Weights must always be point something. Weights must always be point something. 0.2, 0.8, or just 20% and 80%. So weights will always add up to 1, like that. Ladies and gentlemen, again, I'm calling upon you to confirm and assure me that we are together by you guys putting your thumbs up like this or writing yes in Zoom, in LinkedIn, RCM College, etc. Are we together? Are we able to follow up to here? Harold says yes. How about these other ninjas? We have Nancy. Thank you very much. Yes. All right. I'm still waiting to get. I can see I've got so many guys here. Thank you very much, Kerry. Great. Great. So then we've been able to get, ladies and gentlemen, expected return of, you can write this in full. ERP stands for expected return of the portfolio. ERP stands for expected return of the portfolio. ERP stands for expected return of the portfolio. Ladies and gentlemen, having really gotten that, the next thing that these guys want me to do is quite a simple thing. They want me to give them covariance. They want me to give them covariance. So the question is, how do we get the covariance? How do we get the covariance? It will be very important for us, first of all, to appreciate the meaning of the word covariance. Co. Whenever you hear the word co, especially when you are a lady, you are passing around and then you hear somebody saying, this is my co-wife. Run for your dear life. Run away. It means that there is something that is being shared. So whenever we talk of covariance, covariance is the shared variance. This is the shared or common variance. The shared or the common what here or the common variance. The shared or the common variance or the common variance. And how do we calculate this common variance, my good students? To get this covariance between X and Y, we normally take the deviation of X, multiply this by deviation of Y, multiply this by probability, and then you come and do what here? You come and sum. You come and sum like that. So anytime they want to get covariance, now here you are looking at commonality. What is common between X and Y? So it's like you're polygamous. It's like you've got 2 wives here. So you look at the deviation. You can write this in full. Deviation of X times deviation of Y times probability. Deviation of X times deviation of Y times probability. Then how do we get this deviation over X? To get this deviation of X, ladies and gentlemen, this is what we shall do here. So we have here covariance between X and Y. Covariance between X and Y. I have to write it a little bit. Covariance between X and Y, like that. So this covariance, ladies and gentlemen, deviation of X is very easy for us to get it. It is the return of X minus ERX. That is a deviation. Deviation means subtraction. So you're taking the actual returns of X minus the expected returns of X. Then come here, ladies and gentlemen, and multiply this with the deviation of Y. How do we get deviation of Y? To get deviation of Y, we take returns of Y minus expected returns of Y. All right, and then we shall come, ladies and gentlemen, here. Look at what I'm doing. I'm taking the deviation of X, subtraction, 2 returns of X. So we have 2 returns of X, the actual ones and the expected ones. When we talk of deviation of Y, it is 3 returns Y minus expected returns Y, then times probability here, times probability here. And then at the end of the day, we shall come and do what here? We shall come and sum. So then what you will do, you will come and now do the abracadabra here. The returns of X are given here. We have 12, 15, and 16. 12, 15, and 16 minus, minus, minus. Is there somebody who can remind me what the expected returns of X were? Somebody remind me. And I expect to get these responses on LinkedIn all over. Anybody who is following me in Zoom, please remind me. What was the expected return of, what was the expected return of X? We got that earlier on. What is the expected return of X? We had gotten this earlier on. Yeah, Kerry is reminding me it was 14.3. 14.3. How come it's only Kerry who is able to remember? Nancy is also reminding me it was 14.3. So these expected returns do not fluctuate. There'll be 14.3 for X, there'll be 14.3 throughout. So 14.3, 14. So those ones don't fluctuate at all, into brackets like that. Then we have the actual returns of Y. Are you able to see them? They're here. The actual returns of Y, we have 16, we have 18, Then we have 27 minus, minus, minus. Expected returns of y is where I draw the line, because I can't remember it very well. Expected return of y, that has to be given to me by yourselves. So in this case here, they're giving me a figure of 19.2. So this expected return of y does not fluctuate. Expected means the same, average. So it will be 19.2. We have 19.2. We have 19.2 like that. Times, ladies and gentlemen, the probabilities here. So come here and multiply these with the probabilities, which will also remain the same, the common ones here. So the probabilities are already given now. We'll simply come, ladies and gentlemen, here and write down the probabilities here. So our probabilities are the same ones here. They're the same ones here. So times 0.3, times 0.3, times 0.5, times 0.2. So we say equals. And then once we do like that, we shall be able, ladies and gentlemen, to get our numbers. Don't forget, ladies and gentlemen, my polite request of you joining Mwalimu here to study AFM with him. Study AFM with me. So and if you are interested in joining my virtual AFM classes, I charge 4,800 per subject. Of course, apart from AFM, we have all these other papers, the AFR, all the CP and the ATD papers. We charge 4,800 per unit, and this is our number, 0793 555 000. 0793 555 000. That's our number. And of course, don't forget our pay bill. You know, online, there are many people who come and give you other funny pay bills. Funny pay bills. Don't forget our pay bill is 62,42,839. That's our pay bill. And then the account number, you simply give us the name of the papers you are paying for. You are paying for AFM and AFR. You simply write there AFM and AFR like that. AFM and AFR like that. Ladies and gentlemen, then come and really evaluate this. How do we evaluate this? Open bracket. So it is 12 minus 14.3, close bracket. So we have here times. So you come and say times, open brackets, 16 minus 19.2 close. You say times 0.3, then I'm able to get my answer here. So is there somebody who is able to get 2.208? Is there anybody who is able to confirm this number? 2.208, the first one. And somebody in this case, you help me corroborate this. Somebody confirm this number. Somebody confirm this number. Somebody confirm this number, please. Somebody confirm this number, please. Can somebody confirm this number, please? Anybody who is able to confirm this number? Simply use your brackets very well. Use your brackets very well. I could be wrong. If I'm wrong, I mean, you simply tell me, Mwalimu, there, you're wrong, and I normally accept my mistakes very fast, and I repeat. Next week, great. We shall overcome, and you shall pass. We shall overcome, and you shall pass. And you shall pass. Answer confirmed. Answer confirmed. Thank you so much. From there, we go to the second one. Second one, remember, I'm just following. I'm a faithful student. I'm following here brackets. We have 15 minus 14.3, close brackets, times, open brackets, 18 minus 19.2 close, times 0.5, which gives me a negative answer, negative 0.42. How I wish we had some students who were able to get these answers right even before I get them. All right. ATD exam imetoka. Hata ingine toka haraka sana, don't worry. Hata ingine toka haraka sana, we shall overcome. Toka haraka sana, we shall overcome. We shall overcome. We shall overcome. So we have here minus 0.42. I'm waiting for somebody again to confirm this minus 0.42, whether it's correct. Whether it's correct or wrong, And remember, it's not only the Zoom guys who should be giving me these answers. I expect in this case here, guys who are on LinkedIn, guys who are in all this like YouTube, please give me the answers. Please give me these answers. So then we have, ladies and gentlemen, here, 16 minus 14.3 times, open brackets, we have 27 minus 19.2, close. Then we say times 0.2, which gives me In this case here, this gives me 2.652. So this gives me 2.652. And then at the end of the day, they want me to sum everything. They want me to sum this. And once I sum this, I will have gotten my covariance between X and Y. My covariance between X and Y. So I'll come and say there plus point. So the answer there, minus 0.42 plus 2.208. So is there somebody who is able to get a figure like this? Quite a nice figure, 4.444. 4.44 at the covariance between X and Y. Anybody who is able, great. Someone is getting 4.44 as the covariance between X and Y. As the covariance between X and Y. As the covariance between X and Y. So then, gentlemen, we shall be able to stop right here, but just a small word of advisory. Remember now you have got how many compulsory papers? Compulsory papers now, there are 4. We have advanced MA, advanced FM, advanced FR. Then we have, in this case here, leadership and management. Leadership and management. All right. And then you go to the optional papers, we will be choosing between APFM, advanced public financial management. We have advanced taxation, and then AAA. So remember the specializations, you are allowed to double specialize. Specializations, you are allowed to double specialize. And I normally see basically people doing AAA and advanced taxation, given what the market has. I run a firm as well on top of this RCM. I run a firm called Aura & Co. CPA, Certified Public Accountants Firm. So basically we do tax, it's a composite licensed firm where we do taxation, we do audit, we do, in this case, a general advisory, etc. Now, when you finish these papers you are doing, in your case, in our case, you are doing all papers as compulsory. That's why we're being given composite licenses. I can, do financial consultancy regarding in any area, because mine is compound or composite. Now, you guys, if you specialize in taxation alone, then automatically you will not be able to get an audit license. If you do audit alone, you'll not be able to get, in this case here, a tax license. That is why they came later and said, even after you've cleared 2 things, it's either you do double specialization from the word go, you do AAA, and then you do taxation. Or you do just one, and then later when you finish the CPAs, you can come back and redo a specialization that you had left behind, but which you think in the future will affect your profession. Like for instance, I'm telling you, if I never had taxation as one of the consultancy areas, I won't be surviving in the industry of auditing. Because audit is normally once a year. Most of these firms, they don't even give you interim audit. They don't even have interim audits. And even if they have, they'll still ask you to invoice like just once, But audit, nowadays, especially when KRA goes ahead and locks, freezes your client's accounts, you'll be able to charge very nicely. So I love taxation. If I was to choose only one, I would do tax. But again, you can't rule out audit, because audit also will be opening keys for other consultancies, will be the opening key for the other consultant. When you go to audit, like now I audit some of these tea factories. So when you go to audit them, that's when you realize, they have a tax challenge. Even them, before you even discover, they'll tell you, oh, we have this tax challenge. So then, of course, you'll be able to handle what we call also an assurance and engagement within that organization. Ladies and gentlemen, CPA is a great course. That is why you can see even the Kenya National Qualification Authority putting it at same level with degree. CPA being put at the same level with degree. Of course, during these transition times, you will still be forced to do a degree. If you don't have a degree, you need a degree. But rest assured, in the next 5 years, just like you've seen doctors saying about people coming from KMTC. Now, people coming from KMTC, the government is being told here straight away that those higher national diplomas should be equated with degrees for promotion purposes and other privileges. So the same, just like in Scotland, in UK, if you have ACCA, you don't go to a local university to do a degree. But the market right now in Kenya doesn't know that. If I were you and I don't have a degree, I'll still go to a university like KCA after I finish CPA, and then they'll give me so many exemptions, like 17 of like 50% of them. Within 1.5 years, I'll be having what year? I'll be having my degree. All right. And then later on, of course, once CASNEB now is able to fight until CPA is recognized as a degree, I'll be having 2 degrees. I mean, serious people have many degrees. You don't just go for 1 degree. You don't go for 1 degree. So CPA is a very, very good qualification. The only thing that I've always, oh, somebody's getting minus 5.28. I don't know how he's getting, it can't be minus 5.28 because you see, if this is positive and this is positive, all right? So this one here will be 2.6, 2.2, this will be 4.8 around there. So this 4.8, when you deduct, you know, these are deductible value. When you deduct this negative, when you deduct this, then you'll be able to get this 4.44. Just try again, you'll see. And thanks for being honest. It's always good to be honest here. So CPA is a very, very good course. The only thing that I was trying to explain here, most of you come to this course with only one objective. What objective do they have? The objective that normally they have is just to clear what year? To clear exams and the pass. Very few of you come to this course for the knowledge. Trust you me. You, so long as you pass, even if, for example, assuming that CASNEB pass mark is 20%, so long as you keep on passing, the end, in this case here, will be what you're looking at. Not the means here, really. You're not concerned with the means. When I was a student, I made sure that I grasped most of these things, and I can tell you, CPA, when you grasp most of the things, like if it is taxation, you happen to be knowing tax the way you know the back of your hands, everything at your fingertips like this. It's a science, I can tell you. It's as good as medicine, or even better, even better. It's a course that is really, really very satisfying. Myself, of course, you know that my undergraduate, for those that I've taught, is in civil engineering. That's the course that I did. And then somebody told me to CPA, after that I did ACCA, and then progressed like that. I can never regret having done this CPA. I mean, the kind of business solutions we are able to provide. Like now, I may have gone ahead and understood automation part of it. I'm very good in SAP. So there's no way I'll be able to look down on myself that CPA is a bad course. CPA is a good course. What matters most, ladies and gentlemen, is how you acquire this knowledge and your willingness to help. Please volunteer. Even if it's in your church, go and tell your church that, hey, I can be doing these accounts for you guys. All right? Do most of the things pro bono. That's what we did ourselves. Until you get in this case now where you are able to go and say, hey, now this is a good job for me. You get a job opportunity. Most of the times volunteer. Don't like being free. Anytime you're free like a month, call upon these auditing firms. Of course, most of them will not be able to listen to you. Let them give you a window to showcase your talent. Once you get in like a month or 2 months, guys will be able to see your talent like that. And if you do like that, I've seen, ladies and gentlemen, guys really doing very well in this accounting. It will never be cheated. But after this, again, it is CPA. After CPA, of course, you need a degree, as we've said, if you don't have one. If you have one, first of all, take your time before you go up. Before you go to other degrees like the master's now. Take your time here. Try now to understand the automation bit of this accounting. If it's QuickBooks, understand the QuickBooks inside outside. All right? How do you pull this report? How do you do this and this in QuickBooks? All right? Go to Tally. These things are available all over. You can also study them with us. Go to Tally, understand the Tally, because like now Tally is very good in manufacturing accounts. Understand it. If you get a chance, do SAP. And then, of course, as you do that, the underlying data analytics software all over renowned globally is Excel. Excel is something that we are fighting with you every day. Fortunately, most of you are in my class today. Most of you are in my class today, and we are really trying to sharpen your skills, your Excel skills, and you shall overcome. So you guys made the right decision to join the accounting world, but know that there is a lot of knowledge to be understood for you to be able to penetrate the industry very well and get employers like us. We work for multinationals. I mean, apart from RCM during the day, I work for great multinationals. We come to RCM, of course, to help you guys as well. to help you guys as well. But there is no way you can ever convince me that CPA is a bad course. No. To me, it's a perfect course. You can't tell me that it is flooded. Flooded with what? There are many business solutions. It's only that accountants don't know how to market themselves. Something calm, something nice, like I always laugh at you, like TikTok, is a great tool. If you go there and then you start showcasing your knowledge on taxation matters, advisory, it doesn't matter the level you are at. So long as you start, in this case, you're going to do social media, you can even copy some of the things you're doing. All right. But of course, you also must work on your public speaking skills, which is quite a nice skill to get. You simply practice every other day. And once in this case, then you start sustaining debates, like in Zoom Live, like now what I'm doing now in LinkedIn. All right. You will never sleep hungry. Accountancy is a big thing. It's a big industry. You'll be surprised with the proper marketing. You won't even be able to handle the kind of clients who will come your way. Otherwise, ladies and gentlemen, it has been a pleasure hosting you today for AFM. As usual, let's always be the very best ambassadors of RCM out there. Let's talk about RCM so nicely so they can get so many guys to come on board, because ours is more than teaching. Ours is awesome. It's mentorship. It's mentorship. It's mentorship. Otherwise, thank you very much. Have a lovely night. See you again another day. Bye. Bye. Be blessed, Nancy, too. Thank you.